Tesla stock is currently trading at $332.46 per share, while the general consensus often fixates on the latest headlines regarding electric vehicle delivery numbers or the personality-driven volatility of its leadership. The reality is far more tied to the fundamental shift toward integrated energy systems and the long-term potential of full autonomy. Many investors view this as just another automotive stock, but when you look at the infrastructure being built beneath the surface, the narrative changes entirely. The common ground is that Tesla stock represents high risk and high volatility, a play for those who want exposure to the future of transportation. Yet the deeper analysis reveals a company aggressively positioning itself as an energy utility and a software firm that happens to build cars. To understand where we are right now, we have to look at the recent price action. We have seen consistent movement around the $330 level, which suggests that institutional support is holding firm despite broader macroeconomic headwinds. Investors utilizing platforms like Fidelity or Interactive Brokers trading tools are watching the volume, which has been robust, signaling that big money is not exiting the position, rather it is consolidating. If you are doing your own research via an online investment platform, it is easy to get caught up in the noise of daily swings. However, when you contrast that with the sustained capital expenditure in battery manufacturing and energy storage, the expectation of a simple car company fades to reality. The reality is that Tesla is building a moat around energy storage, which could eventually be more profitable than the vehicle segment itself. If you are using Schwab Intelligent Portfolios or a similar robo-advisor, you might see this asset categorized primarily under consumer discretionary. That is where the expectation falls short of the reality. The company's trajectory is increasingly reliant on software as a service, specifically their autonomous driving stacks. When investors log into their Robinhood app to trade, they are often trading the news cycles, but true analysis requires looking at the regulatory approvals and the technical benchmarks they are meeting in real time. Comment below how many shares of Tesla stock you currently hold and let me know your reasoning for staying the course. Historically, people have struggled to value the company correctly because there's no clear peer. Using Fidelity brokerage data to look at historical returns, it is clear that growth has been exponential, but it has not been a straight line. We have seen peaks near $500 and valleys closer to $300. The business model, which once relied solely on selling electric vehicles, has expanded into a multifaceted ecosystem. They own the sales network, they manage their own service centers, and they are now embedding themselves into the grid through energy storage solutions that scale significantly. Even on platforms like SoFi Invest or other user-friendly trading platforms, the sentiment remains polarized. The reality is that the volatility is a feature, not a bug, of a company that is essentially building an entirely new industrial base from the ground up. When we talk about the future, we have to account for the competitive landscape. Apple stock, Nvidia stock, and other tech giants are all vying for a piece of the AI and hardware pie, but Tesla occupies a unique position because of its physical fleet of millions of vehicles acting as data collection hubs. The institutional capital held in Fidelity mutual funds or via Interactive Brokers accounts is betting on this specific data advantage. If the autonomy software reaches a level of maturity that is widely adopted, the revenue model will shift from one-time hardware sales to high-margin software recurring income. This is the catalyst that the market is currently underpricing. The expectation is that margins will remain pressured by competition, but the reality might be that software licensing creates a margin profile we never seen in this sector. Consider the role of SoFi Invest or other user-friendly trading platforms that have democratized access to fractional shares. This has allowed a retail base to maintain massive upward pressure on the stock during pullbacks. Unlike traditional manufacturers where the base of support is thinning, Tesla has a highly engaged base that views the stock as a long-term hold rather than a swing trade. This creates a floor during market corrections that often surprises short sellers. When you are looking at your portfolio on your mobile app, remember that the stock price at any given moment is a snapshot of current sentiment, but the enterprise value is a projection of long-term utility. The risks, of course, are significant. Execution challenges in high-volume production, shifting geopolitical sands that impact supply chains, and the inherent difficulty of scaling a global service network are all real. Many analysts who have a sell rating on the stock often cite these exact operational risks. They focus on the quarterly miss, the temporary softening of consumer demand, or the high valuation relative to traditional auto manufacturers. They are not entirely wrong about the risks, but they are consistently wrong about the valuation because they are using the wrong framework. You can't value a company that is creating its own ecosystem with the same metrics you use for a company that is just trying to sell more sedans than it did last year. As we look toward the next few quarters, the focus should be on the deployment of energy storage units and the progress of the autonomous taxi fleet. This is not just about the vehicle count, it's about the system-wide integration of energy and mobility. If the reality of these deployments exceeds the market's current cautious expectations, we could see a repricing event. Many people are using interactive brokers' fees and account structures to hedge their positions, but the real play is in the long-term accumulation. The sentiment surrounding the brand remains strong, and that brand loyalty is a tangible asset that rarely shows up on a balance sheet, but drives massive customer acquisition costs down to near zero. We also have to look at the macroeconomic pressures. High interest rates have historically been a drag on the automotive sector, yet Tesla has managed to maintain a level of pricing power that its peers simply cannot replicate. Even as others in the industry are forced to cut prices and bleed margin, Tesla has the balance sheet to sustain periods of lower profitability in exchange for long-term market share. This is what investors using Fidelity Wealth Management Services often point to when they discuss the company's moat. It's not just the product, it's the financial flexibility that the product enables. Think about the way you interact with your online investing tools. You are looking for a return, but you are also looking for a story that makes sense. The story here is simple yet profound. The transition to a sustainable energy and transport grid is inevitable, and one company has the head start of a decade. Every dollar invested through platforms like Robinhood or SoFi is a vote for that vision, but the reality is that the vision has to be met with cold, hard execution. The upcoming earnings calls will be the true test of whether the company can maintain that balance between aggressive R&D and bottom-line growth. Looking ahead, the volatility will likely persist. We should expect testing of support levels as the market digests the latest quarterly data, but the core fundamentals, energy, software, and autonomous transport, remain intact. Investors who are using self-investing strategies should be focused on these core metrics rather than the daily headlines that cause short-term churn. The reality, as it often does, will likely land somewhere between the extreme pessimism of the critics and the blind optimism of the enthusiasts. The power in this stock is its ability to defy conventional categorization. It's a car company, an energy company, and a software firm all wrapped into one, and that complexity is exactly why it remains one of the most interesting assets to analyze in the current market. Keep your eyes on the volume and the institutional activity. When the big players begin to shift their posture, that's the signal that the market is finally adjusting its expectations to meet the unfolding reality of the company's long-term operations. The path forward will not be linear, but the infrastructure being laid today suggests that the foundation is far more solid than the daily chart would have you believe.